The Federal Reserve indicates there's still plenty of reason to stick with its $600 billion Treasury bond buying program. Even with a slowly recovering economy, job market prospects remain tough.
The Federal Open Market Committee came out with their latest outlook and a projected high unemployment for a long period of time, plus their long-term outlook for unemployment was still fairly high as well. That would suggest to me that the Fed will remain biased in terms of being easy for a longer period of time. They're not likely to reduce their balance sheet. They're not likely to raise the federal funds rate, I think, within the next year or two.
The nation's central bankers will continue to gauge just how long they'll need to take extraordinary steps to try to boost economic growth. Some experts think they'll have to stick with it even longer than expected.
I suspect that, when you're looking at the data in terms of the unemployment rate, that remains high. The inflation numbers still remain pretty low. They'll probably engage in more bond buying after QE2 is done.
QE2, or Quantitative Easing 2, a reference to the Fed's controversial bond buying program expected to run through the end of next June. One thing the Fed can't control is Congress, but if a tax cut plan is approved by lawmakers and signed by the president, that could be something that makes the Fed's job easier, at least in the near term.
I'm sure that it takes a big relief off their back. Like most economic shops, they probably estimated that a jump in tax rates in the beginning of 2011 would have been negative for the overall economy.
With the unemployment rate on the rise last month, up to 9.8% in November, the pressure is on the Fed, Congress, and the President to do more to lift the economy. Mark Hamrick, The Associated Press, Washington.